This is Daybreak Asia. We're counting down to Asia's major market opens. And Haidi, look, there's a key time we're watching today, and that's 4:15 p.m. in Tokyo, because that's when we're going to get the results from Rengo about the results of the union group negotiations around Japanese salaries and what that means finally for the BOJ meeting next week.
Individually, we all care about pay increases, but I do wonder, has there ever been such scrutiny over a collective set of data on wage increases? But yes, that's going to have big ramifications for signalling, for what we expect out of the Bank of Japan. But, Belle, you know, the other side of the equation is the Fed. Arguably, that has potentially more impact on what we see with Japanese assets, including the yen.
That's right, yeah. Perhaps the bigger driver definitely could be what Jay Powell is going to also be doing next week, what signalling we get from that press conference. But today, this is what we're seeing for Japanese markets as they come online here at the start. Japanese yen holding fairly steady. We did sort of see that knee-jerk reaction overnight when we had local media reporting that they would exit away from negative policy settings next week. As we said, that focus on those union group negotiations. We've got the likes of Nomura saying that the wage hike's likely to be around that 5.1% range. But this is the state of play so far. That yen strength, certainly we have seen it putting pressure on Japanese stocks. And we did actually see the miners starting to outperform yesterday. It'll be interesting to see how that sub-index performs today, given we're seeing iron ore tracking back down to that $100 a tonne mark. But equities are broadly so far under pressure ahead of the BOJ meeting that concludes early next week. Let's change on, take a look at the outlook for Korea in the session today. Very much going to be driven by those moves on Wall Street overnight. Further weakness coming through. As we said, it was that focus on the Fed and the message or the takeaway perhaps from that PPI data as well. We had further data around the resilience in the labour market. Perhaps the Fed can really just afford to take its time when it comes to cutting rates. And so we saw moves higher for Treasury yields, and we saw stocks under pressure. So Korean equities likewise trading in the red so far. Focus on the tech sector as well. In particular, we had the likes of Adobe, for instance, reporting in after hours. And it does seem like they're concerned around competition from new AI entrants into the space. A lot of pressure on any sort of AI-linked name to really start to deliver and see it lifting its bottom line there. But Adobe dropping Haidi, one of the biggest laggards so far in after hours.
We're seeing a lot of laggards here in the Australia session, to be honest. A lot of pressure kind of more broadly, but certainly the leadership, or if you will, in the wrong direction is really the sell-off that we're seeing across miners and materials. We'll talk a little bit about the downside that we continue to see for iron ore in particular. In fact, down almost 10% for the week, the worst week since May, and on track for a sixth straight day of declines. Also a bit of pressure across other industrial metals, despite, of course, the moves to the upside that we've seen from copper, including that biggest one-day jump since November 2022. Downside there, as we see trading in bonds, really following the move that we saw in Treasury yields, government bond yields in the US climbing to the highest moves in more than a week. That report on wholesale prices really eroding confidence or conviction that we'll see the Fed move really imminently, if you will. And taking a look at yields, still pretty much following the track of that, both intermediate and long maturity yields rising as much as 10 basis points during that session. The retail sales gauges were a little bit weaker than expected as well, but rising oil prices, the other piece of the action in terms of restoring the focus back onto inflation. And oil, in fact, holding that 4-month high, the IEA flipping its forecast to a deficit. And interesting, we've also, Bill, got these expectations from Macquarie that we'll actually see a cyclical upswing for the economy and therefore better demand and higher pricing across really the commodities complex.
Yeah, really a lot for us to be digesting this morning, Haidi. But let's bring in our next guest, who's actually been adding to international equity exposure. With us now is Willem Sells. He's CIO at HSBC, Global Private Banking and Wealth. And Willem, I'm interested because there's sort of two different things we're getting out of the US right now. You've got hot US inflation, or hotter than expected from the CPI, the PPI readings. But then you've got the activity data that suggests that cooling coming through. So do we need to sort of temper these expectations around Fed cuts, or are we pricing for the right amount of moves so far?
I think we're pricing for the right amount of moves. We've been waiting actually for this because we have 75 basis points penciled in for this year starting in June, which is now what the market is pricing in. What I'm encouraged by is actually two things in the bond market. Number one, when you look beyond this next year or what is happening in 2024, the long end, and referring to the long dot as they call it, so the Fed expectations, the market is pricing in 3.5. The Fed is thinking they'll go to 2.5. So the market is still too high. That gives you upside for bonds, returns. The other bit is that the real yield is again at 2% for the 10-year. That is too high for the level of growth that we have. So we think that will come down. So bonds are an overweight for us.
Overweight on bonds, and talk us through how that sort of plays into your call around equities then as well.
Yeah, so on the equity side, I care more about that growth element, which is very positive. The earnings as well, especially in the US. You have two countries where earnings momentum is positive, the US and Japan. We'll probably talk about Japan. And then the inflation data, I'm not too worried about that because it's very much at the margin that it is, above expectations. And what you see is that the margins of corporates are still going up. So the equity market is actually taking it more in its stride than the bond market is, right? With a big bond market move, the equity market only moving relatively small in the US last night, because those earnings are there. But certainly, whilst you were probably more focused on bonds at the end of the year exclusively, now it's a mix of both bonds and equities.
What's going to really drive that earnings expansion, though? Is it AI that's going to be adding to productivity gains, or what is it exactly?
Well, AI helps. Obviously, you're going to have AI filtering through into the economy in terms of, productivity gains. And, any business owner that I talk to amongst our clients as well, who are quite often business owners, everybody is looking at how can they use AI in their company to make, gains. In some companies, that's still marginal. In some, it is already quite significant. But I do think that you also have, quite strong demand growth. And we are at the bottom of the economic cycle. In Europe, we've already had the weakest cycle, the weakest quarter. In the US, will probably be this one. But, and then a stabilization and acceleration. Markets looking ahead towards that reacceleration.
When it comes to Japan, mildly overweight on the back of a lot of these common themes that have driven the rally so far. Do you think there's going to be meaningful upside or downside from what the Bank of Japan does in terms of how it correlates to the yen and how much that's been a driver of this equity rally?
So it is. The rally in Japan, to me, is much more than the weakness in the yen, and therefore much more than what is happening with the Bank of Japan. Clearly, it is a very important data point, and our belief is that we're going to have in the wage negotiations at least as much as last year, and therefore, indeed, a normalization of the Bank of Japan's policy. We think they will start with the yield curve control, ending of the yield curve control, and then the following month, a change in the policy rate. But I think it goes beyond that. It's more structural. It's basically this end of deflation, which I think then plays into people's minds, and they are no longer expecting, deflation. That's point number one. The second point is obviously that change, in corporate governance, which is real and which is already having quite significant effect on dividend payouts and therefore shareholder value.
There's also structural changes, of course, when you talk about China, and a lot of them are not necessarily pointing in the right direction for investors. I wonder what sort of prism through which you view value in China right now.
So, in China, we see clearly valuations are very low. We just basically are waiting for the stimulus that is coming through to feed through into actual economic growth and earnings growth for that to create a more positive momentum. In the meantime, we diversify within Asia, and obviously Japan is a big destination. It's also typically has very low correlation to other markets. So that is one of the reasons why we look at Japan. We also look at India, Indonesia, and South Korea, where we all see, opportunities of that supply chain change, but also, digitalization, and in the case of Indonesia, for example, also the net zero transition.
You mentioned Korea just then, and I'm curious how much you're tracking the Value Up program and the chance that Korea is going to perhaps be able to erase that so-called chaebol discount.
Yeah, so, I do think, it's obviously a concentrated market depending on what index you look at. And so the reason why we are positive on Korea is that we do think, with the AI and people looking and being enthusiastic about that, where can we find opportunities outside, the Magnificent Seven. We do like, the Magnificent Seven as well as the rest of the US equity market, but people are looking actively for other ways to play that trade. And South Korea is one of those destinations for us.
All right, Willem, join us next time you're in Hong Kong as well. That was Willem Sells there, Global CIO at HSBC, Global Private Banking and Wealth. And actually, speaking of Korea and the Value Up program, there's going to be a key test of that one that comes through today. We've got Samsung C&T. It's going to be quite a battle, a bit of a showdown between that company and activist shareholders. Essentially, there are funds that are proposing moves around dividend payouts, share buybacks as well. That is going to be tested today in a key annual general meeting. You've already heard from South Korea's National Pension Service, which actually has a 7% stake in Samsung C&T. They're actually backing the company on this so far. But that stock is dropping here more than 4% in the session. 10 minutes underway now for Korea and Japan. Let's switch on and take a look at another sector we're focusing in on today, and that's iron ore companies or names. You've got iron ore there dropping for a 4th straight session in Singapore so far. And you are seeing that weakness coming through, not only in the Aussie miners at the top, but also you've got names in Japan and Korea in turn here. They're seeing weakness. That's the materials index you can see there for the ASX 200. It's leading the decline today. Let's change on because still moving back to the tech space, that focus on what we're seeing in terms of Adobe-linked names here, because we had Adobe dropping, as I mentioned at the top, more than 10% in after hours, giving a bit of a weak revenue forecast, concerns around AI entrants that are entering the space. A little bit mixed so far, what we see, Haidi, in the tech space.
Coming up next, the PBOC may be about to lower a key lending rate for the first time since August as Beijing aims for an ambitious growth target. We get a preview just ahead. This is Bloomberg. You're watching Daybreak Asia. US Democratic and Republican senators are resisting calls to fast-track the passage of a bill that would force TikTok's Chinese owner to sell the app. The bill passed by the House this week demands that ByteDance divest within 6 months or shut down the platform. Democratic Senator Richard Blumenthal says the deadline is too short, and Republican Ted Cruz wants a review that could tie it up for months. However, the Senate Intelligence Committee chair told us that he supports expediting the bill.
They're collecting an enormous amount of personal data about Americans. The genius of TikTok, it kind of knows what you like even before you may know. And that kind of personal data, the 170 million Americans who are on 90 minutes a day, if you don't think that is a security risk or potentially you could be blackmailed at some future time by agents of the Chinese government, then I think you don't understand the unfortunate real world that we live in.
Meanwhile, the top US diplomat to China has hit out against Beijing's objections to a possible TikTok ban. Ambassador Nicholas Burns spoke exclusively with our chief North Asia correspondent, Stephen Engel.
We've heard a number of complaints from the government here in Beijing this week about the American debate on TikTok. I find it supremely ironic because government officials here are using the X platform to criticize the United States. They don't give their own citizens the right to use X, to use Instagram, to use Facebook, to have access to Google. And so it is ironic indeed that the government here is complaining about a process when they shut down access for 1.4 billion Chinese to all of these platforms. Every country has a duty and responsibility to protect its national security. And what the president has done over the last year and a half is to make it impossible for sensitive American technology, advanced semiconductors for AI purposes, to be sold to China, because we know it will happen. We know that the PLA, the People's Liberation Army, will take advantage of that technology to strengthen itself at the expense of the American military. We're not going to do that. We're not going to compromise on national security, and we're not going to negotiate. And you can bet that the government here in Beijing is taking similar measures. They have not allowed, for most of the last 20 years, the export of core, sensitive, national security applied Chinese technology to the United States. And so, you know, every government, and certainly our government, has a right to take these decisive steps, and that's what we're doing.
I also talk to a lot of businesses, and we all know about the FDI numbers, foreign direct investment, down to the lowest gain since 1993. There is hesitation, not only because of the economy is weak, but also because of the myriad of different national security and the opacity of such policy, especially coming out of the National People's Congress. We didn't get a lot of clarity on policy. We do know, and you were in that 60 Minutes interview where you did talk about U.S. companies such as Bain and Company, Mintz, and others who have seen raids and they've seen arrests of U.S. citizens. Can you elaborate on the threat and the pall that has been cast over the investment community and doing business, Americans doing business in China at this time?
I think this is a question central to the U.S.-China relationship for the next year and the year beyond. We have a $575 billion two-way trade relationship. China's the third largest trade partner of the United States. There are thousands of American companies doing business here. Here's the problem. They're hearing conflicting signals. Some senior Chinese government officials say private sector investment is welcome in China, your investment will be protected. But then these companies are also hearing a different message, whether it's the raids against American companies of last March and April, whether it is the opacity of the counter-espionage law, where espionage is defined in such a general way that normal activities in any other country of the world, the collection of data, could be construed as espionage. And so we see American firms backing away, or at least being very cautious about investing a lot of money here because they're not sure where the lines are. And I think the voices that they're hearing from the government here in China about national security, they're the strongest and loudest voices right now.
That was the U.S. Ambassador to China, Nicholas Burns, speaking with our Chief North Asia correspondent, Stephen Engel. Well, meanwhile, Stephen Mnuchin says he's spoken to potential co-investors about buying TikTok from its Chinese parent company. The former U.S. Treasury Secretary made the comment to CNBC but declined to give specifics. Mnuchin runs a private investment firm that accounts Saudi Arabia among its backers. Bloomberg Intelligence estimates that TikTok's U.S. business would be worth up to $40 billion.
I think the legislation should pass, and I think it should be sold. I understand the technology. It's a great business, and I'm going to put together a group to buy TikTok.
You're trying to buy TikTok?
I am, because this should be owned by U.S. businesses. There's no way that the Chinese would ever let a U.S. company own something like this in China.
We do have some breaking news when it comes to Samsung and the CHIPS Act grant that it is potentially going to receive. The US is planning to award more than $6 billion to Samsung Electronics to help the chipmaker expand beyond a project in Texas that it already has announced. That's according to people familiar with the matter. This is under the CHIPS Act grant, and awards are also expected not just for Samsung but also competitors TSMC and Intel. The money from the Chips and Science Act would be one of the major awards from the Commerce Department. It's expected to announce it in the coming weeks. We're also expecting more than $5 billion to Taiwan Semiconductor, according to people familiar with the matter. The federal funding for South Korea's leading chipmaker would come along significant additional U.S. investment by Samsung, according to those sources. Back in 2021, if you recall, Samsung announced that $17 billion project in Taylor, Texas. And of course, all of this really part of these 3 CHIPS Act grants to a lot of these producers of older generation semiconductors, and now we're hearing that more is on the way, Belle.
Yeah, that focus on that geopolitical rivalry between Washington and Beijing. But let's shift back to China now, because most economists that are surveyed by Bloomberg expect the PBOC to stand pat on rates later Friday. But Bloomberg Economics believes China's central bank could deliver a 10 basis point cut to its one-year MLF. For more on this, let's bring in our Greater China senior executive editor, John Liu, there in Beijing. And John, yeah, Bloomberg Economics may be a little bit out of consensus here, but why hold exactly the consensus view if China's economy is off to a weaker start this year?
So I think it depends on priorities because it's sort of a choice between two bad options. One, the economy is weak and cutting rates would send the signal that the government is doing more. It would encourage more lending and borrowing, and that would be a positive thing for the economy. On the downside, there is a gap between Chinese and American rates. And if the U.S. Fed is keeping rates at where they are and China is cutting, that's going to widen that gap. And that theoretically would be reflected in a weaker yuan. And so in the PBOC's position right now, they have to think about what is more important. Is getting the economy growing and hitting the 5% target for 2024 more important than maintaining a stable currency?
John, and of course, with that pretty ambitious 5% target, the data is going to be scrutinised more than ever, right? What are we expecting, and how does it potentially paint a picture that might convince investors that things are maybe progressing better than they think?
So we should get data on Monday for the first 2 months of the year. That's because Lunar New Year holidays, sometimes they're in January, sometimes in February. So we get January and February. Next week, the data is expected to show continued weakness. Economists are expecting retail sales to have slowed from December. We are also expecting investment in property to have continued to decline. And so we've heard a lot about the GDP target for 2024, the government doing more, stimulus measures. That is not expected to be showing up in the data just yet, especially not for the first 2 months of the year. And so continued weakness, and the market generally waiting to see signs that the stimulus is taking effect and things are getting better.
Our Greater China Senior Executive Editor John Liu there in Beijing. Well, the stakes are high heading into Tuesday's Bank of Japan decision. Money managers from BlackRock Demand Group revealing their expectations in terms of whether the BOJ will move. And our Japan economy and government editor Paul Jackson joins us now from Tokyo. And Paul, so much of this comes down to around 4 o'clock this afternoon. Will all be revealed?
Yeah, well, we're waiting for this wage figure to come out this afternoon. This is going to be the average annual pay deals as tallied by Japan's biggest union federation, Rengo. And if this is a big figure, this could help to tip the scales at the Bank of Japan in favor of a March move to raise interest rates for the first time since 2007. So what exactly are we looking for in terms of the numbers? Well, last year, the initial tally was 3.8% for these annual wage deals. So I think anything around that mark is not going to be too inspiring. Economists surveyed by Bloomberg earlier this week suggested 4.1. I still think that's at the low end of what it might be. I think it's going to be a strong 4. We could even get 5. And I think if we get to 5% or in the 5s, that's going to be a strong signal for the Bank of Japan. Now, look, we've already reported that there are some officials at the central bank who favour a March move. There are some who favour waiting until April. So it's kind of balanced there. So the key question here is whether this figure this afternoon can, push them into consensus to move on Tuesday. And hey, if it's 5%, I think that's looking increasingly likely.
I'm curious, Paul, what's the difference between waiting between March and April? I mean, we've already got these indications the wage data is going to be strong. That's what the BOJ wanted to see. What's the difference of, say, 30 days, between now and then for hiking?
Hey, look, I think the kind of baseline scenario was always to move in April. It follows a pattern. Governor Ueda has been doing things every quarter. When there's a quarterly report with forecasts out, there will be a whole load of new forecasts released in April, including a forecast for a new fiscal year. We'll also have a business sentiment survey, the Tankan, out. There'll be more hearings from the regions, from regional central bank officials. And the unions will also be updated updating their wage figures with more figures from smaller companies. And hey, they employ like 70% of Japan's workers. So it's also important to see if the wages are really spreading to the smaller businesses as well. So what this figure today needs to do, it needs to be so high that it convinces officials that there is no need to wait until April, and that with this kind of momentum, small companies must be raising at a rapid pace too.
Paul, we heard from the finance minister earlier saying that Japan is not in deflation. Of course, they had earlier said in the month that they were not considering a declaration to the end of deflation either. But I do wonder whether these, the jump in wages, the progress that's being made, is that feeding through to a better cycle when it comes to sentiment? Is it making households feel more confident about spending, especially when domestic asset prices have been so suppressed?
Hey, look, I mean, you've been seeing wages in real terms falling for month after month, and consumption in real terms has fallen the last 3 quarters. So, to be honest, we aren't seeing a great cycle of positive wage growth feeding into consumption. We have not seen that yet. What are we going to get today? We're going to get a figure for wage deals for this year. So really, a lot of this feed through into consumption is something that has yet to happen. And I think that's why the figure needs to be very high today in order to convince officials that now is the time to move.
That was Bloomberg's Paul Jackson there. And just recapping one of the breaking lines that came out just a few minutes ago, this is Samsung. We understand that it's poised to win over $6 billion to expand its investment into its US operations there. This is according to sources that are familiar with the matter. But we understand those funds, $6 billion, would help the chipmaker expand beyond a project in Texas that has already been announced. We don't know exactly where yet that additional investment would be located, but we are hearing that that money would also be directed to its rivals, TSMC, Intel, so they're also likely to get some cash from the US government, in addition to Samsung getting that $6 billion. You're watching Daybreak Asia, just recapping a breaking news headline from the last few minutes. Samsung dropping a little bit so far in the session, but we're hearing from sources that the US is planning to award Samsung more than $6 billion. This is going to be helping Samsung expand its operations in the US. There's already a plan or a project in Texas that's been announced, but this would be to help invest in an as-yet-to-be-named location. But let's bring in Bloomberg's Peter Elstrom joining us now from Tokyo. And Peter, this is just going to be one of several major grants that could be awarded over the next few days.
That's exactly right. Yeah, the Biden administration has made their efforts to build a domestic semiconductor industry one of the core platforms of their economic plan. Very important for them. The CHIPS Act is going to have a big chunk of grants, about $39 billion in grants, as well as loans that companies will get. And the key chip makers are now beginning to get to the point where they can see how much money is going to be allocated for them. Samsung, of course, South Korean company, the biggest memory chip maker in the world. It has had operations in the U.S. in the past. It's planning on building a $17 billion facility in Taylor, Texas. And now this money, $6 billion, is going to help them expand even beyond that in the U.S. We also understand that TSMC, the Taiwanese chip maker that makes many of the most advanced logic chips, including for NVIDIA and for Apple, is close to getting some money too. So the Commerce Department is beginning to pick up speed after what was kind of a slow start in terms of allocating this money. Intel, also an American chip maker, of course, is planning on getting some cash here too. So they're beginning to move down this process of doling out the money that will help build this domestic semiconductor industry.
Yeah, that Intel package said to be over $10 billion. We're also hearing of separate money set aside for military chip use as well. Peter, do we know what these packages comprise of? Are they loans? Are they grants? Are they sort of financing guarantees? And does that make a difference for a company like Samsung?
Yeah, it is a combination of things. The grants, obviously, are the money that they would prefer to have at this point for some of these facilities. The loans also, at some point, you have to pay that money back. But there are some strings attached that have caused some hesitation from some of the companies. The Commerce Department has put some conditions on these processes, and that's part of the reason why this process has been quite slow in the United States compared to other places, particularly here in Japan. TSMC, which has most of its fabs in Taiwan, is building a plant here in Japan and then also is trying to build one in the U.S. It's gone much more quickly in Japan. They doled out the money very quickly. They got a lot of construction workers on site, and they built the fab in a very, very short amount of time. In the U.S., it's been much slower, partly because of the government issues, partly because of union issues and some other factors.
Peter, of course, this takes place amidst the ongoing tech rivalry, shall we say, between Washington and Beijing. Does this sort of funding, does the CHIP Act give the US a considerable head start in terms of, ultimately not preventing China from being able to have this tech, but certainly slowing its progress down?
Yeah, I think I wouldn't say it's a head start. I mean, right now you have most of the advanced semiconductors in the world made in Taiwan or in South Korea. The U.S. is not in the same ballpark as those two countries right now. China is investing in its own domestic chip industry. It's not as advanced as what a TSMC can do or a Samsung can do for that matter, but they've been investing in older generations of chips, which they see as very vital to the economy. I think for the U.S., this is a strategic issue. They want to be able to have a dependable supply of semiconductors for some of the key industries, particularly the auto industry. You'll remember that the auto industry had to close down factories in the United States, in Japan, and in Europe when there was disruptions to the supply chain during the COVID pandemic. So countries are very concerned about that, and they're also concerned about possible increasing tensions between the U.S. and China over Taiwan, where so many of those advanced semiconductor fabs are right now.
Bloomberg's Peter Alstrom there with that breaking news. With more on geopolitics, and voters are headed to the polls in Russia for a 3-day presidential election, with Vladimir Putin all but assured of winning a 5th term. Despite the cost of his war in Ukraine and the long-term economic challenges, the Russian leader is said to be preparing for a long confrontation with the West. Let's bring in Graham Gill, who's a professor emeritus at the University of Sydney, who focuses on Russian politics. And Professor, great to have you with us. And, Vladimir Putin finds himself at an interesting position, right? There's increasing evidence that perhaps Russia has the advantage when it comes to the conflict with Ukraine. The economy seems to be weathering all of the sanctions quite well. And the opposition looks increasingly futile domestically. So is he in a pretty good position?
Well, he's clearly in a pretty good position to consolidate his control within Russia. It's quite right to say that the opposition is in a parlous state. There are only 3 other people who are running in the election, and none of them are likely to get anything more than 4 or 5% of the vote. Given that Putin is clearly very popular, but also that the electoral process is structured in such a way as to produce an overwhelming majority for him, he's clearly going to win the election. And internationally, certainly things are not going all of his way. I mean, NATO has expanded. He certainly didn't want that. But within the context of the Ukrainian war, things seem to have turned in Russia's favour. And it remains to be seen when the fighting season opens again over the next couple of months, whether Russia can push that advantage through to get to a period or a position in which Putin is happy to call a halt. And if he can get to that position where he thinks he can say this has been a win for us and he can gain what he wants from Ukraine, I think he will then look to end the war. Then it will depend upon whether the West responds positively to that or not, and what happens with Zelensky in Ukraine, who has basically put his future on a military victory. And that military victory just looks to be more and more of a chimera the longer we go on.
I want to get your views in terms of the international response and how they deal with Russia going forward. But I do wonder about domestic sentiment. It's been kind of referred to as a learned indifference. Is there an unusual sense of normalcy in terms of society in Russia? Because clearly there are oppressions, there are, the sort of tightening of the screws, there's war fatigue, there's sanctions fatigue. But how does he deal with the population at large?
Well, the Russian system has been set up over the last 30 years in such a way as the ideal for it is an apathetic populace, as people who are not interested in politics, people who are more interested in getting on with their own lives, in making their livings, in bringing up their family. And Putin has tried to create that atmosphere and to maintain that atmosphere during the Ukraine war. And he's done this in a number of ways. One is by the restrictions in the reporting of the war, so that there's very little negativity about the war coming across the mainstream press, the mainstream media. He's tried to ensure that the economy continues to function in such a way that the Russian people do not experience significant shortages, and he's been able to achieve that, at least in the cities, which is the most important part for him. And he's pressed down on the opposition, so that the likelihood of there being any major popular opposition to him and to his continued rule is now pretty small. I mean, it's possible that with the election we will see some demonstrations taking place, but the likelihood is that they'll be met in the same way that demonstrations in the past have been, and that is by being put down by the police.
It really does seem, Graham, that there's a lot of factors that are running in Putin's favour at this point in time. So does this mean that we're seeing someone who's perhaps got an increasingly emboldened mindset, and then what are the ramifications of that in turn?
Well, I mean, you may have an increasingly emboldened outlook, but the problem is, in terms of expansion of Russia, it's not really clear where it would expand to. I mean, if you exclude Ukraine, basically Russia is confronted by a border of NATO countries, and it's not going to attack NATO. There's no reason why it would attack NATO. It knows that if there was a major conflict between NATO and Russia, given the balance of forces, the likelihood is that NATO would win. So there's not going to be, I think, an expansion in a military sense with following the election. What he will do is that he will gain increased confidence that the West is weak, because this is clearly what he believes, what he believed when he went into Ukraine. He believed that the West and NATO would not respond in the way that they did. Well, if the West now withdraws from NATO, which it is likely to do in one form or another over the next 12 to 18 months, it may be that he gets that impression again. But it's not going to lead to military conflict or military expansionism by Russia. It may lead to increased economic disruption, but it won't be a military one.
And to your point, I mean, yeah, it does appear that we're setting up for sort of like a long confrontation with the West, and that these ties have, if not severed completely, have been severely damaged. Yeah. How does that also play into Russia's ambitions, perhaps around creating a sort of parallel world order where you've got the likes of the BRICS countries that are more operating in unison versus the US and its allies?
Well, it clearly plays into that scenario, but the main driver of a potential BRICS-based international order is, of course, China. And China is the one whose economy has been going gangbusters up until the recent past. It's the yuan that has been seen as the potential replacement currency for the US dollar if it was to come to that. And Russia is sort of part of that process. And the more that he perceives a rejection by Europe of Russia, and that's the way he sees it at the moment, the more he perceives a rejection Russia by Europe, the more he'll be inclined to turn towards China and to the other sort of countries that are in BRICS or that surround BRICS.
There are limits potentially to this so-called no limits friendship, do you think? And what do you think could be the pressure points between Beijing and Moscow?
Well, there will be pressure points. I mean, one is that, as I've said, China is the main driver, and China is conceivably then going to be the dominant partner in that new relationship. That won't sit easily with the Russians because they clearly see themselves as being a superpower, just like the former Soviet Union, and so there'll be frictions over that. There'll potentially be economic frictions because the economies don't really mesh all that well. I mean, Russia certainly provides a lot of raw materials and energy to China, and China in return has traditionally provided sort of consumer goods, but the more Russian industry develops after the war, we assume, the more it's going to move into those sorts of areas of developing the sorts of things that China sells to it. And so there's going to be sort of friction at the economic level as well, and at the political level, as I said.
Graham, what happens if there is a change in US leadership after November and presumably funding dries up, support dries up for Ukraine? Belle asked you whether this sort of lack of support potentially then emboldens the likes of Russia and China as a proxy, looking at potentially what they do with Taiwan.
Well, I don't think Russia will get involved in Taiwan, but if Trump comes to power and the American plug is pulled on Ukraine, what we will see is, I think, a reasonably rapid end to the war, because I doubt very much that the European unity on the war will be able to be maintained once Biden's leadership is gone, so that if there is this dramatic decline in Western support in the provision of arms, and if there's no supply of NATO troops on the ground, given the comparative power inequalities between Russia and Ukraine, I think what we'll see is what we expected to see at the start, and that is that Russia will be victorious. Now, whether that translates into greater danger for Taiwan is a bit unclear. What we do need to remember is that when Trump was in power last time, Trump was even more assertive towards China than Obama had been and than Biden has been. And so if that assertiveness continues to manifest itself, that may actually lead to a change in Trump's position on Taiwan and a reinforcement of American commitment to support Taiwan. Now, whether, if push came to shove, they will go ahead with that is really anyone's guess. But in many ways, for America, for the US, Taiwan is more important than Ukraine is.
Graham, thanks for your time this morning. That was Graham Gill there, Professor Emeritus at the University of Sydney. And you can read this full story of today's big take by turning over to the terminal or by heading to Bloomberg.com. You can read that story in full. But we'll have more ahead on Daybreak Asia. This is Bloomberg.
The US Ambassador to China, Nicholas Burns, says channels of communication between the two nations' militaries are starting to open up. Let's get more from our exclusive interview as the ambassador weighs in on US alliances in the Asia-Pacific and Beijing's increased military spending.
The two presidents, President Biden and President Xi, agreed in San Francisco that we would begin again serious high-level communication between our militaries. This is critical.
Has it happened?
It's beginning to happen, and it's critical because our two militaries are operating in very close proximity to each other in the Spratlys and Paracels and the Senkakus and the Taiwan Strait. And so our new chairman of the Joint Chiefs, Chairman Brown, has had a discussion with his Chinese counterpart, and we hope very much that Secretary Austin will be able to talk to his counterpart in the coming weeks or months, and then we hope there'll be even conversations at a more tactical level between our militaries. This is common sense because you want to drive down the possibility of any kind of accident or misunderstanding between our air forces or our navies.
We do know at the National People's Congress, China increased the military budget by 7.2%, the biggest increase in 5 years. First of all, are you concerned by that, or how should we read that?
Well, what we're concerned about is the fact that the PLA is not transparent about how the money is being spent. You know, in the issue of China's nuclear weapons buildup, they're not transparent with the rest of the world, and that's a problem. And of course, you know, the United States has been a principal military actor in the Indo-Pacific since the close of the Second World War. What we've been doing, and President Biden has had a lot of success in this, is to build up our alliances with Japan, the Republic of Korea, the Philippines, Thailand, Australia. We've created AUKUS, and of course we have the Quad with India, all designed to protect the democratic countries of this region and protect international law in places like the Taiwan Strait and the South China Sea.
We're also hearing that the Biden administration wants to and is exerting pressure on allies like the Netherlands, like Japan, like Germany, like South Korea, to further the curbs of other products into China. How does that not expand that pressure and actually bifurcate the relationship further?
We've been very clear that we adhere to a small yard, high fence scenario, meaning these are targeted actions that regulates AI investment by American companies in the AI sector here. These are common sense actions by the United States. Any American government would have to take this action given the competition we have underway in the military sphere between the People's Liberation Army and the United States. And I don't think there's an American alive who would say that we should sell advanced technology to the PLA. So the president's acted in the national defense here, and as I said, we're not going to negotiate or compromise on this. And these are the actions that a government has to take to protect in the 21st century. In an age when technology is at the heart of international politics, some of it has to be regulated.
That was the U.S. Ambassador to China, Nicholas Burns, with our Chief North Asia correspondent, Stephen Engel, in Beijing. And you can watch us live and see our past interviews on our interactive TV function. That's TV Go. Check it out. This is Bloomberg. CATL is reporting its results this Friday. It's the world's largest EV battery maker, and it could see a jump in full-year earnings, signalling that it's weathering fierce competition in China and a drop in raw material prices. For more, let's bring in our Asia transport reporter, Danny Lee. And Danny, I'm actually really curious on this one because we've been talking so much about the consolidation in the energy sector, or EV sector rather, and also that lower demand that we're seeing for EV batteries. So why are we expecting such good results from this company?
What they've been able to do in the final quarter of the year is able to regain market share, not just domestically, but outside of China in particular, where they have better control over pricing. So overall, what this has meant is been able to undermine rivals. It's been able to strengthen its competitive edge, and where its market share in China is almost 50%, and outside of China, it's in the mid-20s, early 30s. It's a pretty good position to be in, and they are able to then report a set of results that they preliminarily guided to at the end of January. That is basically better than what the market expected.
Is pricing expected to stay as favourable as we've seen for this company, especially when it comes to overseas expansion?
Yeah, I think for someone like CATL, when you're looking to grow abroad, this is an important segment for them, and especially where in China there has been a lot of competition, from other battery makers, which we did see play out earlier in the previous year, and particularly in the previous quarters. But as they continue to expand abroad, and with their whole suite of lineup of manufacturers that they supply, including the most famous one, Tesla, they are able to keep control of the pricing, and that kind of feeds into not just the top line but also the bottom line. So it's a pretty good outlook when you look into this year, when it's well positioned to continue to gain strength and gain market share.
All right, one to track. That was our Asia transport reporter, Danny Lee, there joining us. And just taking a quick look at how stocks are faring so far in the session. One sector is standing out to the upside so far. That's energy names, because we have oil holding around a 4-month high. We had the IEA as well overnight forecasting a deficit instead of a surplus that was earlier seen. So that stock is moving, or group of stocks, to the upside. To the flip side, and what's really dragging down the broader benchmark so far is the mining names here. You've got iron ore under pressure again for yet another session, and we are seeing these laggards coming through, particularly in Australia so far. Samsung CNT, that's one to note as well, because that focus on Korea's value up program is going to be tested today. Essentially, there are activist investors that are proposing changes around dividend payouts, share buybacks to this company. It's now being pushed back on by the company, and also the country's national pension service is backing Samsung CNT. So we are seeing that stock sliding so far.